All right, so let's take a deep dive into Warren Buffett's latest moves.
Okay.
This time, we're going to unpack his Q3 portfolio changes
Right.
based on his 13F filing.
Yeah,
Basically, a public snapshot of what the Oracle of Omaha is up to.
exactly. And this quarter's filing has really raised some eyebrows.
It has.
Yeah.
For starters, he sold a hefty 25% of his Apple holdings.
Yeah.
Doesn't this make you wonder if even Apple is losing its shine in his eyes?
Not necessarily.
Okay.
Remember, Buffett is a long-term investor.
Right.
This could be a strategic reduction.
Okay.
He often trims his positions gradually once he initiates a sale.
Mm-hmm.
The 13F doesn't reveal why he's selling,
Right.
but it does give us valuable insight into how one of the world's most successful investors is reacting to the current market conditions.
That makes sense. It's not like he dumped his entire stake.
Right.
But then we also see him selling 22.77% of his Bank of America shares,
Yeah.
bringing his stake below that 10% threshold.
Yes. Dropping below 10% is intriguing. It means any future Bank of America sales won't trigger mandatory public reporting.
Oh.
So he could be planning to sell even more without us knowing.
Almost like a stealth exit strategy.
Right.
Okay, so we've got these big sales,
Yeah.
but then we see him buying Domino's pizza.
Interesting.
This move definitely surprised me.
Mm-hmm.
What do you think he sees in a pizza chain? Well, especially after selling off tech giants like Apple?
Domino's is more than just pizza delivery these days.
Okay.
Their online ordering platform is incredibly efficient.
Right.
They've shown impressive resilience in the face of economic headwinds,
Okay.
consistently growing revenue and profit year over year.
You're right. I hadn't thought about that. It's not the same Domino's we knew back in the day.
Right.
But is this a classic Buffett value play? Their market cap is around $15 billion, with a price-to-earnings ratio hovering around 26 and a dividend yield of 1.3%.
That's a great question. It's definitely not a deep value pick in the traditional sense.
Okay.
Domino's valuation isn't screaming bargain, but it does align with his criteria of investing in solid companies with strong fundamentals.
Mm-hmm.
And those fundamentals are pretty solid: 6% year-over-year revenue growth,
Wow.
almost 15% profit growth, and strong U.S. same-store sales. Those are impressive figures, especially in the current climate.
It's interesting to see how he's balancing those classic value principles with an eye toward companies that are adapting and thriving in the digital age.
Yeah.
Domino's certainly fits that bill.
Okay, then we have another curious purchase, Pool Corporation.
Okay.
They distribute swimming pool supplies, but their performance hasn't been nearly as stellar as Domino's.
Interesting.
In fact, their financials are showing a decline.
You're right. Pool Corporation's recent performance has been less than sparkling.
Right.
Revenue is down 5% year over year.
Mm-hmm.
Profits have taken a 16% hit, and their valuation doesn't exactly scream, "Buy me."
Yeah.
So what's Buffett seeing here? That's the million-dollar question.
It's almost the opposite of what he's doing with Domino's.
Right.
Maybe he sees an opportunity in a sector that's temporarily down.
It's a contrarian play of sorts.
That's certainly one possibility. He might be betting on a future rebound in the pool industry.
Right.
Or perhaps there's a strategic angle we're missing. Maybe he sees potential synergies with other businesses in Berkshire Hathaway's portfolio. It's definitely a move that warrants further investigation.
It's interesting how these two new purchases are so different.
Yeah.
Domino's is riding high, while Pool Corporation is facing some challenges.
Right.
It makes you wonder about his overall strategy here.
It does raise the question of whether these smaller purchases are more exploratory in nature than his core holdings.
Okay.
Perhaps he's testing the waters in new areas, or maybe these decisions were driven by his investment managers rather than Buffett himself.
Right.
We can't know for sure, but it's something to consider.
All right, so we've got these big sales and intriguing new purchases.
Right.
But let's step back and look at the bigger picture. What does all of this tell us about Buffett's overall strategy right now?
Well,
Especially with those massive cash reserves he's built up.
Well, the most striking takeaway is that even the Oracle of Omaha is proceeding with caution.
Okay.
Berkshire Hathaway is sitting on record levels of cash,
Wow.
even surpassing the levels seen before the 2008 financial crisis.
So instead of hunkering down, it's more like he's strategically positioning himself for the next big move.
That's a great analogy.
Okay.
He's not just sitting on the sidelines, he's actively analyzing the board,
Right.
looking for the best opportunities to deploy that capital when the time is right.
So even though he's being cautious, He's not out of the game.
Exactly.
He's just playing a different game than we might expect.
And that's a key takeaway for any investor, whether you're managing millions or just starting out.
Okay.
Understanding the market environment and adjusting your strategy accordingly is crucial.
Right.
Even the most successful investors in the world adapt to changing conditions.
That's a valuable lesson.
Yeah.
It's easy to get caught up in the hype or panic when the market fluctuates. But Buffett's approach reminds us that staying disciplined and focused on the long game is crucial.
Absolutely. Remember, investing is a marathon, not a sprint.
Right.
Buffett's moves highlight the importance of patience research and a willingness to adapt your strategy as needed.
So before we move on to part 2, let me pose a question to you.
Okay.
If even Warren Buffett is being this cautious, what adjustments should you be considering for your own portfolio? Stay tuned for part 2, where we'll delve deeper into the implications of these moves and explore more actionable takeaways you can apply to your own investment journey.
Sounds good.
We just left off talking about Warren Buffett's mountain of cash.
Right.
It's sitting there larger than life, and it has everyone wondering what he's planning.
It's not just the size of the cash reserves.
Right.
It's the fact that it keeps growing.
Right.
It suggests he's not finding many compelling opportunities in the current market.
That's fascinating to me.
Yeah.
It's not like there's a shortage of companies out there.
Right.
But maybe he's looking for something specific.
Yeah.
Something that aligns with his philosophy in this particular market climate. What kind of opportunities do you think he might have his eye on,
Well,
given his value-oriented approach?
he's always emphasized the importance of investing in companies with a wide moat.
Okay.
That means businesses with a durable competitive advantage,
Right.
something that protects their profits from rivals. Think about companies like Coca-Cola or Apple. They have brand loyalty, economies of scale, and a track record of innovation.
Those are definitely not the companies struggling to survive, that's for sure.
Right.
But they also don't come cheap.
Yeah.
How can he possibly find those wide moat companies
Right.
at a price he considers a good value?
That's the challenge, isn't it?
Right.
Finding value in a market where valuations are high.
Right.
But remember, Buffett has a long-term perspective.
Right.
He's not looking for quick flips.
Okay.
He's willing to wait for years, even decades, for his investments to mature.
Wow.
He's looking for intrinsic value,
Right.
something that goes beyond the current market hype.
That's true.
Yeah.
He often talks about buying businesses, not stocks.
Right.
So maybe those wide moat opportunities are out there.
Yeah.
But they're not necessarily the flashy high-growth companies that everyone else is chasing.
Right.
Maybe he's looking at more traditional, stable businesses that are being overlooked.
That's a very astute observation.
Okay.
In fact, some analysts believe he might be eyeing sectors that benefit from rising interest rates.
Oh,
Financials, for example, tend to do well in a rising rate environment.
that makes me think back to the Bank of America sale.
Right.
If he's bullish on financials, why sell off a chunk of Bank of America?
It's possible he sees better opportunities elsewhere within the financial sector.
Okay.
Or maybe he's just trimming his position to rebalance his portfolio.
Right.
Remember, we're only seeing a snapshot of his holdings, not the entire picture.
It's like trying to solve a puzzle with only a few pieces.
Yeah.
We can speculate, but we don't know for sure what his grand plan is.
Right.
But let's go back to those new additions, Domino's and Pool Corporation.
Okay.
They seem to represent two very different strategies.
Yeah.
Domino's is embracing technology and adapting to a changing consumer landscape.
Right.
Pool Corporation, on the other hand, is in a more traditional industry that's facing some headwinds.
You've hit on a key point.
Okay.
These purchases, particularly Domino's, challenge the perception of Buffett as a purely old-school value investor.
Right.
They suggest he's not afraid to adapt and invest in companies that are leveraging technology to enhance their business models.
So maybe he's not as stuck in his ways as some people think. Maybe
Mhm.
he's evolving his approach, just like the market itself is evolving.
Precisely. And that's another valuable lesson for investors.
Okay.
You can't be afraid to adapt.
Right.
The market is constantly changing, and your investment strategy needs to evolve along with it.
You have to stay curious,
Right.
stay informed, and be willing to adjust your thinking.
Yeah.
Now, speaking of a changing market, let's talk about inflation.
Okay.
It's been a major concern for everyone, and investors are no exception.
Right.
How do you think Buffett's investment strategy is positioned to deal with this inflationary environment?
Well, one of Buffett's core principles is investing in companies with pricing power.
Okay.
That means companies that can raise prices without losing customers.
Right.
They have a degree of control over their pricing, which helps protect their profit margins even when inflation is high.
So companies that sell essential products or have strong brand loyalty.
Exactly.
That makes sense. But How do you identify those companies? What should investors be looking for?
Look for companies with a consistent history of profitability,
Okay.
strong brand recognition, and a loyal customer base.
Okay.
Think about the products or services you use every day that you'd be willing to pay a little extra for.
Right.
Those are the types of companies that tend to weather inflationary storms better than others.
That's a helpful framework.
Mhm.
But what about the impact of inflation on his cash hoard?
Well,
Doesn't it lose value over time if it's just sitting there?
that's a valid concern. Cash is definitely eroded by inflation,
Right.
but for Buffett, that cash is a strategic asset.
Okay.
It gives him the flexibility to act decisively when opportunities arise. Right.
To acquire companies or stocks at attractive prices during market downturns.
So it's not just about preserving capital.
Right.
It's about having the firepower to capitalize on market volatility.
Exactly. He's not just waiting for inflation to subside.
Right.
He's actively managing his portfolio to navigate this challenging environment and come out stronger on the other side.
That's an important distinction.
Yeah.
It's not passive, it's strategic. Now, before we wrap up part 2, I'm curious to get your take on something.
Okay.
Do you think Buffett's moves, particularly the large cash position and the shift towards companies like Domino's, signal on the broader shift in the market? Is this a sign that the tides are turning and we're headed for a different kind of market environment?
That's a great question and one that many analysts are pondering.
Right.
It's always difficult to pinpoint a definitive shift, but Buffett's actions certainly suggest a heightened sense of caution
Okay.
and a focus on value in a market that has been driven by growth and speculation for quite some time. So should we all be hitting the pause button, reassessing our portfolios, and maybe looking for those wide moat companies that Buffett seems to favor?
It's never a bad idea to take a step back and reassess your investment strategy.
Right.
Market conditions change, and your portfolio should reflect those changes. Ask yourself, are your investments aligned with your long-term goals and risk tolerance?
Okay.
Are you comfortable with the level of risk you're taking?
It's easy to get caught up in the day-to-day noise of the market,
Right.
but it's crucial to keep those fundamental questions in mind.
Absolutely.
Remember, as Buffett has shown us time and again, patience and discipline are essential for long-term success in the market.
Couldn't agree more.
Join us for part 3, where we'll put all these insights together and explore some specific strategies you can use to navigate this evolving market and build a resilient portfolio that aligns with your goals. Welcome back to the final part of our deep dive into Warren Buffett's recent portfolio moves.
Yeah.
We've explored his intriguing sales, his new purchases, and that massive pile of cash he's holding. And we've touched on some valuable lessons we can all glean from his actions, even if we don't have billions to invest.
Absolutely.
Exactly. Now let's get down to brass tacks.
Yeah.
What are some actionable takeaways from Buffett's moves that we can actually apply to our own portfolios, regardless of our account size?
Well, first and foremost, remember the importance of diversification.
Okay.
Buffett himself doesn't put all his eggs in one basket.
Right.
Berkshire Hathaway owns a diverse range of businesses across various sectors, from consumer goods to energy to technology.
So spreading the risk is key, especially in a market that seems to be sending mixed signals.
Exactly.
But how much diversification is enough? Is there a point where too much diversification could actually hurt your returns?
That's a great question. There's a balance to be struck.
Right.
Too much diversification can dilute your returns and make it harder to track all your investments.
Okay.
Focus on building a portfolio of 15-20 carefully selected stocks across different sectors that align with your investment goals. This provides a good balance between risk management and potential returns.
That makes sense. Don't just blindly buy a little bit of everything. Choose your investments strategically. Now, another thing we've talked about is Buffett's long-term perspective.
Yeah.
He's not chasing quick profits. He's buying businesses he believes in for the long haul.
Right.
But how do you actually cultivate that long-term mindset when the market is constantly tempting you with short-term gains?
It's definitely easier said than done. It's human nature to get caught up in the excitement of a rising market or the fear of a falling one.
Right.
But remember, investing is a marathon, not a sprint.
Right.
One helpful strategy is to focus on the underlying businesses you're investing in.
Right.
Instead of checking stock prices every day, spend time reading annual reports, learning about the company's management team, and understanding their long-term growth strategy.
It's like shifting your focus from the scoreboard to the actual game being played.
Exactly.
Understand the players, the strategies, and the long-term potential.
I like that.
Yeah.
Now, another thing that stood out to me is Buffett's emphasis on value investing.
Right. He's always looking for those undervalued gems. But as we've discussed, valuations are pretty high these days.
Yeah, they are.
How do you find value in a seemingly expensive market?
It's certainly more challenging, but not impossible. You have to be willing to look beyond the obvious.
Okay.
Instead of chasing the hottest trends, consider those unloved or overlooked sectors that might be poised for a comeback.
Okay.
Think about industries that are undergoing structural changes or facing temporary headwinds.
Right.
Those are the areas where you might find hidden value.
So be a contrarian, go against the herd mentality. I can see how that approach would require a lot of research and conviction in your analysis.
Definitely.
Speaking of research, you mentioned earlier that Buffett is known for his deep understanding of the businesses he invests in.
Right.
How can everyday investors who might not have the same resources as him conduct effective research?
There are plenty of resources available to individual investors.
Okay.
Start with the company's website, their investor relations section, and their annual reports. Read industry publications and analyst reports.
Right.
Listen to earnings calls and pay attention to management's commentary.
Mm-hmm.
It's about piecing together information from various sources to form your own informed opinion.
So it's like becoming a detective, gathering clues and building a case for or against an investment.
Yeah.
It's not just about numbers.
Right.
It's about understanding the narrative behind those numbers.
Exactly. And don't be afraid to leverage technology.
Okay.
There are fantastic online tools and platforms that aggregate financial data,
Right.
provide stock screening capabilities, and offer access to educational resources.
Mm-hmm.
You don't need to be a Wall Street analyst to do effective research.
It's about being resourceful and utilizing the tools at your disposal.
Hmm.
Now, before we wrap up this deep dive, I want to bring up one final point that's been a recurring theme: market timing.
Okay.
We've established that even Warren Buffett, with all his experience, doesn't try to time the market.
Right.
So why do we as everyday investors often fall into that trap?
Because it's tempting to think we can outsmart the market, to predict when to get in and when to get out, to maximize our profits.
Yeah.
But the reality is market timing is incredibly difficult, even for the most seasoned professionals.
So instead of trying to time the market, what should we be doing?
Focus on time in the market.
Okay.
Invest consistently over time, regardless of short-term fluctuation.
Right.
This approach, known as dollar-cost averaging, helps mitigate risk and smooth out the bumps along the way.
So it's about staying disciplined and sticking to your investment plan, even when things get bumpy.
Exactly.
Don't panic and sell when the market drops, and don't get greedy and chase returns when the market is soaring.
Right.
Stay the course, be patient, and let the power of compounding work its magic.
That's the essence of long-term investing.
Right.
It's not about getting rich quick. It's about building wealth steadily over time.
Mm.
And that's a lesson we can all learn from Warren Buffett, even if we're not investing billions.
So there you have it. We've taken a deep dive into Warren Buffett's recent portfolio moves, and we've extracted some valuable insights that we can all apply to our own investment journeys.
Yeah.
Remember, diversification, a long-term perspective, thorough research, and a disciplined approach are key ingredients for success in the market.
Absolutely.
And never underestimate the power of continuous learning. The market is constantly evolving, so stay curious, stay informed, and never stop seeking knowledge.
Couldn't agree more.
Thanks for joining us on this deep dive. We hope you've gained some valuable insights and a renewed sense of confidence in navigating the exciting world of investing. We'll see you next time for another insightful exploration of the market and strategies for building a brighter financial future.